Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
Welcome to the Turnaround Podcast. My name is Stephen Phillips. I'm a solicitor based in London and founder of the restructuring boutique law firm Fry Libertas. In this, our second show, I have asked experienced market analyst Bill Blain to join us to talk about the economy and policy. I came across Bill on a potential investment which didn't happen, but was intrigued by his newsletter, The Morning Porridge, which Bill, I'm sure, will talk about more. Bill is often invited onto the media, and I think his popularity has got a lot to do with a rare combination of fearlessness and an entertaining delivery style. Whilst Bill and I inhabit slightly different ecosystems, me in the world of financial restructuring, we will have a lot to discuss over the next 30 minutes. The state of the economy and policy is, of course, a key consideration and driver for the restructuring of financial restructuring. So over to you, Bill. Thank you very much for agreeing to appear.
Oh, delighted to do so, Stephen. Delighted to do so.
So, Bill, I think before we get into sort of the depths of the economy, etc., I think the audience would like to know a little bit more about you. How you got into your career and what you've been doing these past few years and what you're doing now.
You said we only had 30 minutes.
Yes.
I'm going to struggle to get it into that. Okay, but let me try and get you a very condensed version of what I've done and what it is I'm doing. I mean, I have spent the last 40 years nearly in financial markets. And to be honest, it has been fantastic. But I never ever wanted to be an investment banker. All I ever wanted to be was a journalist. And that's what I intended right from the start. But I couldn't get into journalism school because I can't spell. It turned out years later that we have some gene in the family that means we're all, suffering some degree of that word blindness thing. But whatever. I ended up falling into the city by accident. And as a result of that, a couple of years later, found myself getting offered a job at Euromoney. Now, at the time, I was working for one of the US investment banks, Morgan Stanley, where I was doing extremely well, considering on a relative basis. But yeah, I jumped ship to go to Euromoney for half the salary and no bonus. And I absolutely loved writing about the markets, but I very quickly realized that you just weren't going to survive or be able to buy a house in 1980s London working as a journalist. So I wormed my way back into finance. A few years later, I actually got poached again by Bloomberg, where they asked me to come on board. And although that was a much better paid role as a journalist, again, I got pulled back into the financial markets, where I've been ever since. I then spent the next 15 years working for another US investment bank, Bear Stearns, which was frankly fantastic. I learned so much, including the key lesson, which is information is only valuable if you can withhold it. And based on that, it was a very successful time. It was a great firm to work for. People really managed to pull things together and get the place working. And over the years, I built up a business working with financial institutions, raising capital for them. And one of my great clients at the time was HSBC, and I got headhunted by them to come on board and run the financial institutions group for the bank. And that's when I discovered, although HSBC is a firm comprising of wonderful, good people, it was very much regimented into the way that you were brought up within the bank to think and act. And if you were an outsider like myself, you didn't really fit in. So after about 5 years of that, it was clear that I wasn't part of that, and I decided it was time to move on. And so with a bunch of friends who were elsewhere in the city, we decided to launch a credit hedge fund where we're looking to use leverage to create something quite spectacular. But the problem was that was in 2007, which people will remember, saw the run on
Yes.
Northern Rock and the beginning of the global financial crash. Now, we very quickly realized that the way to make money in this very difficult market where there was chronic illiquidity in any kind of bank paper was to go out and sell that paper back to the banks. And what I mean by that, if somebody was holding, say, 10 million of a bank's subordinated debt and they were panicking because banks were falling like pin, what would you say, pinballs? I don't even remember what the word.
Yes, I think we know what you're saying. Yeah,
banks were going bang all over the place,
including the Bear Stearns one that you were talking
Bear
about.
Stearns, of course, was one of the first to go. And unfortunately, I'd kept some of my stock in the bank. I'd been forced to because of a peculiar profit sharing thing I'd entered into years before. Eventually, I got, I think, $10 back on it. But banks were majorly at risk. And we took the view that based on what we were seeing, most of them would likely get bailed out, which is exactly what we saw happen after Lehman Brothers. So we'd seen that. We were buying bank paper and selling it back to the banks. I said we'd buy 10 million of subordinated debt back from an investor at 30 cents and then sell it at 31 cents back to the bank, because that meant they got a 69% lift to their capital. In other words, their capital base increased because they'd effectively got their money back at a discount. So that was all very effective. And I realized very, very quickly that the world was changing dramatically because banks were getting absolutely thrown out the window by the way that regulators were starting to clamp down on them as an increasing number were regulated. Now, at this time, I realized that every morning, as I was calling our clients, effectively as a salesman, except trying to buy stuff from them, that I needed something to talk to them about. So as the Northern Rock crisis started, I wrote a little note on it saying, the Bank of England should be acting. This is not necessarily, this is just a short-term liquidity crisis. And so I put it down in a note, and I think I sent it to 30 of the financial institution investors that I spoke to. And the next morning I sent round another note following that one, and I decided, well, I need to give this a snappy title. So I thought, okay, everyone knows me for being a Scotsman, and a slightly plump one at that. So what's the best way to start your morning? You need a healthy porridge, a healthy breakfast. And what's the most healthy breakfast you can have? It's porridge, this Scottish staple. So I decided that Blain's Morning Porridge would be the name of our morning commentary. And as I say, it started off with 30 people. Within a year, it risen to about 1,000. And now there's over 10,000 subscribers, some of them who actually pay me for it. You can get the full service on www.morningporridge.com for a mere £10 a month. But the subscriber base is mostly institutional investors active in the global markets, but also a good number of regulators, bureaucrats, and by that I mean people working in treasuries around the world, in debt management offices, but also a fairly large number of politicians, both here in Europe and in the US, get the morning porridge. Now, what I've discovered over the years of writing is nobody particularly wants the news. You can get that on Bloomberg from the FT, which is the first thing I read every morning. Followed by the Tory graph, because it's very important to know what the enemy is thinking, as they say. You can get your news from practically anywhere. When you're looking for opinions, everybody has got them. But if you're looking for insights, there's only so much you can come up with yourself. So what
Mm,
I'm doing is, unlike every other comment, well, maybe not, but unlike other commentators, I'm not just writing the Morning Porridge. I'm also still working in what we call the alternative asset space, which we can come back to in a moment. So
mm,
most days, I'm trying to write the Morning Porridge by 9 o'clock in the morning, get it out the way, and then I
mm,
run around the market and ask them what's going on, what are they thinking. I've got a number of deals always in the works that I'm working on, but really get a chance to speak to people. And based on these conversations, you're able to draw some insights. And it's these insights on what's going on in the financial markets that people find valuable and in some cases even pay up for.
yeah. Well, look, I love it so much that I put it on my website as a useful site to know. So,
Good,
um,
thank you.
and I think your background is you did a economics degree, is that right?
Well, yeah, recently, well, I did an economics degree at Heriot Watt University in
Yeah,
Edinburgh. And despite the fact that I came out with a Desmond, a
yeah,
tutu,
yeah.
as they say, Heriot Watt
That was
recently saw,
another era.
yeah, another era completely. But
Yeah,
after graduating in 1994 with a Desmond, a 2-2 in economics, I actually loved economics. I found it fascinating. The area that let me down was mathematical economics, because
mm,
I slept my way through the lectures. But I found all of economics absolutely fascinating. But recently, well, a good couple of years ago, I started lecturing at Heriot Watt,
mm,
going up and lecturing their postgraduate degree within the Edinburgh Business School on their
yeah,
investment management course. And then just last year, the university saw fit to punish me by making me an honorary professor of economics, which, to be honest, I consider one of the greatest honors I could ever be given. So
yes,
every time I go up and lecture, and I love doing it, I always take the students into the old student union building, where my name is actually up on the wall, because while I was there, I played at student politics and
mm,
found myself president of the student union at one point. So I
mm,
can go into the student union. I'm still allowed to buy bar drinks as if I was a student. And I tell
mm,
you, that's brilliant, because I was up there 2 weeks ago. I took
mm,
30 students out for drinks,
yeah.
and we had a few, and it was less than 100 quid.
It's almost like going to Weatherspoons, possibly.
It was
Um,
a half the price of a spoon, Stephen. It was
Really,
marvelous. Yeah.
very impressive. Anyway, we should get into the substance of this. But I noticed this morning the FTSE had actually hit over 8,000. I'm not sure if it's sort of gone down a little bit, but it feels to me that we're in this very fascinating era of possibly, are we going to have a bit of a sort of breakout moment for, even small stocks, etc.? And is there going to be a sort of a real, a kind of bit of a, 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 a boom? I mean, that's the way the stock market has been seeing it for the last few months. Or is this just a sort of bit of a sort of bear market trap? And I'd love to know your view at the moment of where we are on the economy. I realize stocks aren't the economy, but I love to sort of get your sense of where we are in the cycle.
Okay, well, there's a couple of points there. First of all, you're quite right. Stocks are not the economy. Secondly, the FTSE is definitely not the UK economy. It's always been famous for being anything but the UK economy. I think the third thing to point out is the FTSE has become, sad to say, over the last few years, little more than a sideshow when it comes to global equity markets, which I think reflects one of the things I think we should talk about, which is what's going on in real financial markets rather than just what we see in terms of stock markets. Now, if you read any newspaper like the FT every morning, it'll be full of stuff about listed stocks. What it doesn't talk about so much is what's going on in the bond market, which is where all truth resides,
Yeah.
and what's going on in what we call the alternative asset sector or the real economy. So there's a couple of points there. But going back to your question, where do I think stocks are going? I am still very much of the impression that stock prices globally remain profoundly distorted by the effects of the last 15 years of quantitative easing, the period of zero interest rates. If you end up setting the interest rate in economy far too low, as was done right up until 2022, that has tremendous distorting effects on the relative value of everything. And we're only now, sadly, beginning to understand what the effects have been, not just on stock prices, but in terms of corporate behaviors, and particularly in terms of equality across society, where if you're generating massive returns because of the amount of money that's been pumped into stock markets by negative interest rates, and that is all going to a very small part of society, it generates almost a kind of blindness to what's been going on in the economy. And it generates secondary effects in terms of politics, particularly the rise of populist politics. And I think we can maybe talk about that as well at some stage, because I'm convinced many of the problems that we're seeing stem to the behavioral aspects of quantitative easing and that era. So if you were to ask me, does the stock market look ready for a pop? Well, you know, it's difficult to say. I have been wrong about so many things in the short term, but long term have been right. And let me give you one example about that. I mean, for the last 8 years, I've been saying Tesla is profoundly overvalued, massively overvalued. This is almost scamish, the claims that are being made for Tesla. And you know what? I've been wrong every single time. Tesla continued to go up and up and up. But it's only now that people are beginning to see that, yeah, Tesla exists in a very competitive market where it's struggling to sell cars at the kind of margin that it was making. And all these claims about self-driving are going to prove very difficult to deliver on. So perhaps at the kind of PE multiple it was at, it is massively overvalued. And that's why Tesla has been one of the worst performing stocks this year. But that kind of realization moment can follow years behind people like me who are watching the market every day in, day out, saying, this doesn't make any sense. And we can have the same conversation about multiple other stocks and even sectors like cryptocurrency.
Yeah, I mean, if you would sort of pick out a few sectors that you would sort of personally think, well, you know, I'd avoid or they're due for a bit of a downfall, what would you sort of focus on? You mentioned obviously Tesla. Are there other areas?
I think there is still a hangover from the era of ultra low interest rates. And if you think about this for 1 minute, the global financial crisis in 2007, 2008, that is now what, 16 years ago? Is that right? Yeah, 16 years ago. Most of the people who are now working in financial markets around the globe are going to be in there, you know, who have reached a position of some responsibility, managing money, responsible for decisions. A large part of them, and I estimate it to be around 60% of those who are actually influencing decisions, are in their early 40s, which meant that they really only began their careers around the time of the global financial crisis and all the distortions that then followed as central banks engaged negative interest rates, and we saw all the interventions to save banks. And I often ask people about this, and I still get the expectation that if there is a major financial crisis, then the central banks are going to jump back in to rescue markets again. And that profoundly changes the way they think. It changes their attitude to risk because they think they're wearing life jackets. And so it tempts them to jump in, where maybe an old dog like myself is thinking that that doesn't look terribly sensible. So I think there is still a mood of fervid speculation. And you can see that particularly, I think, in the AI market just now, artificial intelligence. Now, what NVIDIA has done in creating or repurposing its gaming chips to be able to teach AIs to put together this facsimile of intelligence, and everyone is jumping on that bandwagon to predict how this is going to improve productivity. It's going to create all kinds of new ways of companies profiting and that kind of thing. That is all following a trend that I've seen develop over the last 10 years, 15 years, which is to jump on a bandwagon, whether it's digitization, the Internet of Things, the metaverse, you name it, or companies that are basically selling real estate, calling themselves, internet stocks, whatever. These things follow trends, and if they don't burst, they just gently fade away. So I suspect that AI, although it could be intensely significant and will create massive changes, which are probably going to be for the better for everybody, the prices are probably over exaggerated. And I also think that this mood of fervid speculation that's taken hold because of the cohort that is now running finance and the fact that they never really experienced real markets, that's going to change the way that we continue to think about these things until people learn the bitter truth. And that bitter truth is that things are never as good as we hope. Fortunately, they're seldom as bad as we fear.
Yes, yes, that's a mantra that you use a lot. I think the counter to a little bit of pessimism is you look at inflation; it seems to be sort of trending absolutely in the right direction. Many jurisdictions, employment seems to be staying up. America's particularly in a good shape in that regard, but the UK and the rest of Europe aren't too bad. So it sort of does feel in a way that we this sort of soft lending does seem to be maybe real. And yes,
Are you willing to bet on your feelings, Stephen? Because
it's
I've started using a new expression. I've called it stickflation.
yes,
Because I'm looking at inflation headline numbers coming down, but I'm looking at the details in inflation. I'm saying, look, key things: agriculture, some parts that are necessary to keep things going. Just little details continue to go up. And so I'm thinking, all you need is some sort of small shock, even that bridge disaster in the US, which will cause a couple of weeks of difficulties for US car exports and other bits and pieces. These things will continue to push inflation up, and that's without there being shocks. But also in the employment data, you just need to take a look at the revisions that we see in the only reliable statistics that we have, which are the US numbers, and they're constantly being reevaluated till you almost get a flat line. Here in the UK, the numbers are just not good enough to really put much trust in. And there are also so many people that are out the market that I think you need to get a better feel of how the economies work rather than trust your feelings or listen to what the papers have their biases are telling you.
I think what I'd say in the restructuring sort of arena, where you see a lot of data with default data or high yield default data or insolvency data, you've certainly seen on the small business side a lot of businesses just giving up the ghost. Hospitality in particular, where it's just become very difficult to make a living, where the costs are so high. and taxes remain high, it's difficult to keep those kind of businesses going. So we're seeing a lot of businesses close down. We haven't seen a huge default rate spike in some of the larger caps yet, but that could just be that it will take some time for these sort of longer interest rate shifts to make themselves felt. But I suppose I've sort of been slightly cynical in that I was incredibly busy as a restructuring lawyer from about 2008 onwards for a number of years, and then QE came in, and the government sort of just wanted to dampen down any possibility of a deep recession. And then each year, restructuring professionals gather and say, "This time next year we'll be millionaires," and it never quite happens. So it's definitely increased in activity levels, but we're certainly not seeing quite the real spike. So it's an ongoing discussion to be had.
Right, but if we go back to that question, I mean, are we headed for a soft landing? I really don't think we've got there. You correctly noticed that there hasn't been the rise in default rates, even in the junk markets, because credit has remained available, albeit at more expensive costs. The big refinancing hump is still to come. I
Yeah.
think there are a lot of questions to be asked about the way that private equity has leveraged up companies to an extent that they really don't even expect them to survive a major refinancing hurdle. These things are all certainly possible. But I think we have to look at the real economics of the situation, and this is where politics also comes into it. This question about hospitality, it came up in a recent discussion I had with our local MP, who's a very
Yeah.
good conservative MP. He's really diligent, but he was taking a whole bunch of questions from local businessmen, an event I was asked to attend. And many of their questions from the hospitality sector was, look, we cannot cope with rises in the minimum wage or the living wage, as it's called. We cannot cope with the higher costs that are being imposed on us from X, Y, and Z and energy costs and things like that. But really, the real question these people should be asking themselves is perhaps about discretionary income and discretionary spending. Because if you take a look at the vast majority of the population, they have seen their real incomes crash on the back of inflation. Because inflation, let's not forget, is always a tax on the poor. If inflation rises, it hits the poor hardest. They've
Yeah.
seen their local council taxes rise dramatically here in the UK. They've seen their national taxes rise. They've seen their energy prices rise. These are the people who are funding themselves. Well, let's expand this to the US, because these are the people who are finding themselves financing their daily spending through borrowing on their credit cards at 20-25%, who are having
Yeah.
to buy their second-hand cars on 35% auto loans. And these are the people who are seeing the guys who own the companies they work for having fantastic holidays and a great lifestyle because their pension pots have gone up and they all look exceedingly wealthy. And these are the people who, because they have very little discretionary income left to spend, who are going to cause a recession. It's not companies going to be bust because interest rates have gone, although it's going to be an issue. It's because nobody has the money to spend anymore. And because these people have nothing to spend and they see the top end of society that's done so well because of the redistribution of wealth from QE, these are the guys who are out voting for the populists. And this is exactly what MAGA, Make America Great Again, has successfully appealed to. Donald Trump has been brilliant in the way that he's managed to pull these people in because he's recognized exactly what their problem and discontent is. And we're seeing the same thing here in the UK, where people are recognizing that the elites don't seem to have any contact with the problems that we're seeing, which is why you're seeing this split in UK politics, where everyone expects most of the votes in the so-called red wall will go back to Labour, but a significant number of the very same people who voted for Brexit will go for reform, which is the sort of similar hard right, make the UK great again kind of vibe. So there is something, there are some profound economics at work here as well. And, I keep getting told by people, Bill, why do you keep going on about politics? Because the problem is politics really does matter for markets. It's politicians who set state spending. They're the ones who decide what the money is going to be spent on. In other words, creating opportunity multipliers across the economy. They're the ones who set taxes, which sets how much money you have to spend. And they're the ones who empower supposedly independent agencies like the Bank of England and the Fed to go and set interest rates to fight inflation and stimulate the economy. So, politics really does matter. And the effects of politics here in the UK, where you and I have both seen it, is a combination of austerity and political dither and the uncertainty over Brexit has created this atmosphere of broken Britain, which is much the same as we see in the US with an opening for MAGA. And that creates all kinds of issues.
Well, I'm glad you mentioned Brexit, because I see Brexit as in some ways, you can characterize it in different ways, but it was a big sort of effort of restructuring the British economy. And it's interesting. I think you and I have gone on different trajectories, because I think I pretty much like not every, but many professionals in the city were pretty against it. I felt that this was going to be a 10-year period of difficulties and negotiations, and it was going to cause some chaos. I've since actually changed my view on this, and in fact, I spent last weekend with a hedge fund guy, a fund manager who runs a lot of UK money, and I asked him whether we should, if we had it again, would you vote for Brexit, to go back in or not? And he says no, it will be too much disruption. And I felt the same way, which is that we've gone through the choppy period. There are some opportunities like the CPTPP and all sorts of other trade deals, etc. So I wouldn't advocate going back in, even though I didn't vote for it in the first place. What do you where are you on Brexit? I'd love to know. I think you were pro, but maybe you've rowed back somewhat.
Well, like everyone else in the city, or most folk in the city, I started off as very much a Remainer during the campaign.
Right.
But during the campaign, I began to think about it a little bit, and I had reservations. But I began to think about it and said, look, maybe this isn't such a bad idea. And having studied the way that the European Union, particularly the European Central Bank, had handled the sovereign default crisis in the early 2012-ish, I had some serious doubts about how the whole thing worked. And I came to the rather surprising conclusion that maybe it wouldn't be such a bad idea at all, and that there was some upside, but I caveated that quite carefully. What I think went wrong was just how unprepared the UK was. Having read the last really good Boris Johnson biography, which talks about the sheer horror that he experienced the morning that he woke up to discover that he had supposedly won, because he was expecting to lose and then be able to use that as a shoe-in to UK Prime Minister. There was no plan. And what we've really seen is a battle within the Conservative Party that has completely distracted from any attempts to meaningfully lead the country since 2015. And that's been exacerbated, I've got to be honest, by the absolute failure of the Labour Party to have provided any sort of competent opposition during that period. Things have now changed. The Conservatives remain in a complete dither, but at least Labour looks organised. But I would agree with you now, Stephen. It's too late to be talking about going back into Europe. And I'm not entirely sure that would actually be a very good idea because of what they'd force us to go through. But what we desperately do need to find is a new accommodation within Europe for the UK, which has got to be a very much, we want to be friends and we want to be close and we want to be part of a trade agreement with you. But we also need to be very much at the center of the wider European question of security as well. And that means the UK has got to completely change its approach to defense as part of NATO, which is going to become a major issue, I suspect, later this year after the US elections.
I think, are you alluding to Mr. Trump's sort of very lukewarm words about NATO, and are you really suggesting that any negotiation with the EU is really going to include a defence deal?
I'm not sure it needs. We don't need to link a defence deal with the EU with closer ties, but it needs to be part of the olive branch that the UK offers Europe, which is our full, wholehearted embracing of a new NATO, which will probably be far less US centric. And that's independent of Trump getting in. Trump has said that he says all kind of things. I very much doubt he would actually pull the US out of NATO, but it's clear that Europe has to be responsible for its own defense. And I think that's one of the things that we can offer. But at the moment, like everything else in this country, our defense is as broken as our aircraft carriers.
You allude to Labour, and I think we all see the polls, so the expectation is they're likely to win. Do you see that as a positive? I mean, are there things you see in their policy platform that might be helpful, or have they been so sort of quiet about their platform that we just don't know what's coming?
I think we need far more detail from both parties as to what exactly they are planning. I think we're getting a much stronger mood of competency from the Labour Party. If anything, Labour seem to be trying too hard to be better Tories than the Tories ever were. But I think we need to look at some of the details. Now, over the years, I've sort of constructed a sort of framework to think about politics and markets. And I call this the virtuous sovereign trinity. And that happens when you have a stable currency, a sustainable bond market, and political competency. If you have all three legs of that stool, then generally the economy will be fairly stable and provide a good platform for growth. And by a stable currency, it's got to be something that's going to be generally tradable, and it's going to be something that benefits the country. The sustainability of the bond market is critical. But political competency is a wide topic that covers everything from the right decisions getting made in the legislature, right down to the right regulatory response and things like avoiding corruption. All these things go in. Now, it's clear that for many, many centuries, the UK had a virtuous sovereign trinity. We actually saw it tested to the extreme during Liz Truss's brief period, where that stability in the bond market was upset when her massive unfunded tax cuts caused the bond market to crash, and that then reflected in a stumble in the currency. And that was all due to political incompetency. So that kind of theory works. Now, when you get a change of government, how is the market going to look at the UK's political competency? Well, that's why I think Labour are doing the right thing. They're assiduously courting the city so there are no surprises, and that Labour will be able to come in showing that they can be trusted with the economy. Now, that, of course, has always been the great myth that the Conservative Party will tell everyone that Labour can't be trusted with the economy. And I would counter that by saying, just take a look at, say, the water companies. They were privatized in 1980. Was it 1989?
Sometime in the late 80s, yeah.
1989 they were privatized. And all the if you look at Wikipedia, it will tell you they got 6 billion for privatizing the water companies. In fact, that's not true. It was only 1 billion because they gave away 5 billion of debt with the privatization as well. Now, during that period, they paid out an enormous amount in dividends, and they have made investments. But if that dividend money had been invested back into the companies rather than paying private shareholders, we wouldn't be facing the somewhere in the region of 200 billion infrastructure bill that we're going to be required to pay just to get our water and sewerage up to speed. Now, I'm particularly interested in this because just at the other side of the house here, we've got the River Hamble, where I like to go swimming in the morning. And last year I picked up norovirus swimming in the river because of the pollution. And basically I'm having to stay out of the water because I'm now susceptible to it. So I want our rivers cleaned up and I want them done soon. But that's going to be very difficult to do. So when people tell me that Labour are going to screw up the economy, I've got to respond, okay, they might, but no more so than the Tories did.
Well, if you were going, if we flatter ourselves to think that Rachel Reeves and Sir Keir are listening into this, what would you be telling them in terms of, here are some concrete things that you as a market commentator think that they should be doing?
All right, Stephen, you know my mantra, the one about things are never as bad as we fear, but seldom as good as we hope. One of the big things we're worried about is national debt. I think there are ways that we can persuade markets to finance infrastructure rebuild. We need to have a rethink about how we do that. That involves the kind of changes that both parties are talking about in terms of planning to make it more effective and faster, to reduce the ridiculous cost of doing anything in the UK compared to any other nation. And we need to be thinking about how do we spend the kind of money that's required on water, sewerage, rail, roads, education. I mean, there are so many different things, defense, you name it. How do we do it? Well, one of the ideas that I keep mentioning is what I call the zonk theory. Yes, I can see you're intrigued. Zonk theory.
Yes.
So
I haven't seen that. Yeah.
Okay, so here's my plan. It's dead simple. At the moment, as a result of quantitative easing, we're now into quantitative tightening, which means selling all the debt that the Bank of England bought during the crisis. Now, at the moment, the Bank of England holds somewhere in the region of 746 billion of gilts, the UK's sovereign debt market. That's about 30% of the total amount of outstanding government debt. That's an asset on the balance sheet of the Bank of England. It's equally a liability on the UK Treasury, which owns that money. So here's the idea. They're both part of the same balance sheet at the end of the day. So the Treasury simply gives the Bank of England a very small coin with the head of King Charles on that coin, and on the other side, 746 billion pounds a zonk. And at that point, writes off all these gilts. That would reduce the UK's debt to GDP ratio down to about 70%. Now, at this point, there is a scream from every single monetary economist in the United Kingdom, but this man is mad. How can you possibly do that? Well, tell me some good reasons why we can't even at least consider it.
Mm. Well, what would be the benefit? I mean, apart from it just looks
Because
like
you get it
you've
back
reduced
now.
30% of your debt.
Yeah,
Is it?
because you reduce the debt down. Now, there is the common theory held across the financial markets, the Reinhoff and Rogert theory, that as soon as debt goes above 70%,
Yeah.
that's when it becomes dangerous. But I
Mm.
think it just shows that the government is willing to think about ways of creating headroom.
Mm.
I think it's well worth considering.
Yeah.
There are some reasons that I'm not going to go into where it may
Mm.
create issues and it may scare some people. But I think if it demonstrates that debt is debt and there are ways to handle it. I mean, you've been involved in multiple debt restructurings throughout my
Yeah.
career. I've seen numerous restructurings of sovereign debt. Every single nation in the Western world just now faces a massive debt crisis. How do we solve these problems? Well, we're probably going to have to think about restructuring debt at some stage anyway. So why not
Yeah.
get there ahead of the pack and start thinking about it? It would give us some hope of a future, I feel.
Yes. I mean, that trajectory, for many Western nations is looking unpleasant. Put it that way. And there's been a whole bunch of debt restructurings or defaults over the last few years, particularly in Africa, etc. So it feels to me like that's that we're on a trajectory where this has got to be dealt with.
Well,
And I
remember,
guess
no nation that is financially sovereign, in other words, holds the key to the printing presses, ever goes bust. What happens is they print more money and that causes their currency to collapse, which leads to all the other parts of political incompetency that I talked earlier about in my sovereign virtuous trinity
yeah,
theory.
yeah,
So that's where it goes wrong. What you've got to do is carefully manage these three sides of the stool so that the debt market remains sustainable and open so that the country can fund itself, so it's
yeah,
attractive to global investors,
mm,
and the currency remains stable so global investors aren't scared off. And to
yeah,
do so, you need to show that we're solving problems. What's
mm,
wrong over the last 14 years is we haven't solved any problems. All we've done is let existing ones fester.
yes. Now we've not surprisingly been focused on negative things. In a sense, that's what my show's a little bit about. In terms of distress. But what are you, just to sort of finalize this on a slightly better note, what are you sort of saying to some of your clients as to where you would invest at the moment?
Oh God, there's so many areas that I think are absolutely that I don't want to give the impression there's no hope, because that is not true at all. There are so many interesting things going out there,
Mm,
and I can quote you, superb investments from everything from financing UK property redevelopment, where investors can receive 12% on um, loans into rebuilding into markets that are going to rise, or even aviation, where the value of second-hand aircraft is shooting up through the sky
mm,
because of the slow deliveries of Boeing and Airbus.
yeah,
There are so many interesting things going on in terms of technology that I think will be of enormous relevance when it comes to food security, which is going to be one of the big issues that climate change raises. I mean, let's not forget, whatever the truths of climate change are, it's happening. So you're going
mm,
to have to prepare for it. The oceans are warmer than ever before, and that's generating the storm systems, and that is going to have consequences in creating, very wet summers like we're seeing here in the UK, but also drought in places like the Med, and
mm,
especially in the Sahel in Africa. And that will have all kinds of consequences for food security, but also migration. Now, when it comes down to food security, how do we ensure that we have enough to eat? I mean, 50 years ago, we solved that with the agricultural revolution. Some of the things that are going on in the aftermath of things like I cannot believe it's not meat are fascinating in terms of it being able to grow proteins out of sugars. And that's going to be an enormous area. And then, of course, there is AI, which earlier I kind of dished on the basis that we're overemphasizing how exciting it's going to be. But it will create it has the potential to create productivity gains. And if we can get productivity gains, then nations will afford to grow their way out of the debt crisis they're currently in, and we'll be able to see wages rise. So we go some way to reversing this kind of income inequality that is driving much of the political populism today. So I don't want to give the impression that I'm some kind of uber bear the whole time. I think it's just very important that people need to be aware these are the bad things, and you only get the good things if we solve them.
Yeah, agreed. Well, Bill, I've taken up lots of your time, and it's been really, really interesting.
Stephen, I feel we've only covered about a third of the topics that we should have covered, but it has been great. And thank you for putting up with me speaking for most of the time.
No, it's been very interesting, and I get the sense that if this series of podcasts sort of get a bit of traction, I'll try and get you back on to talk about the other 2/3. But thank you very much for your time, and no doubt speak soon.
Thank you very much.
Thank you.
You've been tuning in to the Turnaround Podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, freilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.